Good evening, and welcome again to Public Perspective. I'm your host, Kevin McDermott. And in tough economic times, it's sometimes difficult to know what it is you should do. How should you manage a budget? How do you handle your taxes? How can you be helped in trying to manage your money in times when it's very important to do so? So our guest tonight is the president of the Center for Economic Progress, David Marzahl. David, thank you so much for joining us tonight.
Glad to be here. It's a pleasure as well.
So after that introduction, why don't you tell our viewers a little bit about what the center is and how it works and who your customer base is?
I'd be glad to tell you. I mean, bottom line is our focus is on moving low-income working families from financial uncertainty to financial security. In times like this, literally half the population meets our criteria. I mean, we're definitely an organization that targets people, kind of working folks who are struggling. But as we've seen in the last few years, the ranks of those have grown enormously. I mean, the degree of uncertainty in people's financial lives nowadays has meant that the demand for our services is overwhelming. What we try to do, though, is at core in terms of our mission is to provide people with everyday financial tools and support to help them succeed. A focus being on financial capability, building people's understanding of putting together a budget, negotiating everything from a financial aid package for their children going off to college, to getting their taxes done, to dealing with credit and debt. I mean, we're kind of a full-service shop that uses volunteers almost entirely, Kevin. In fact, we have about 1,500 active volunteers.
And it's a not-for-profit organization.
We're a not-for-profit, so we do not charge for any of our services. Kind of the core concept is any household making under $50,000 a year is eligible for our services.
Now that's interesting, $50,000. In many cases, people would think, well, that's a lot of money. $50,000, you should be making a pretty good living at that. And yet you're finding that at that cutoff level, people are still struggling. Right?
Absolutely. I mean, first of all, to be honest, the average or the median income of people we serve is much closer to $15,000. So we're generally serving people who are very much in need. They're working, most of them working either full-time jobs or putting together 2, 3, 4 part-time jobs, many times lacking benefits. And it's just a real tough go for them. And they may be on their own, they may be with children. But yeah, the $50,000, in the old days, you'd say $50,000, you'd be doing just great. But in the Chicago metro area, if you're a family with 2 kids and 2 adults, $50,000 is not going to get you very far.
Doesn't go that far.
No, it won't.
And if we think about that, $50,000 doesn't take you that far. Then if you're making 15 and you may have a child or 2, how on earth do people in that income bracket actually make it?
Well, one of the things I was trying to say before is that we're an organization that relies almost entirely on volunteers to do the work. And I'll tell you a little later about kind of where we're located and how we operate. But one of the things that the volunteers always tell me is they're amazed at how industrious people are at, when they are only making $15,000, $17,000, $18,000 a year. I mean, in many cases, they may be doubling up with family in a household. They may obviously be working side jobs. I mean, what we help them access in many cases on the tax side is a significant refund, which really helps them out. But in reality, anyone, especially a family of 1 or 2 kids making $15,000 a year, over any period of time, they're going to have a hard time. And these are families that even if they're working full year, they're still going to be eligible for, and if the employer doesn't provide it to them, some form of subsidized health insurance that will help get them that access to the health insurance. They may even be eligible for food stamps at that level of income. I mean, $15,000 with 1 kid is technically below the poverty level for the Chicago area.
Well, what I think is so interesting, the word you used a minute ago was that the people you work with are very industrious. They work hard, right? So that it somehow doesn't fit the national narrative we're hearing now, that people who are making very little money somehow have brought this upon themselves, they're lazy, they didn't do the right thing, whatever it is, but somehow they're to blame. But here, your experience seems to be the opposite of that these are people who really do want to get ahead, they're working very hard, but somehow they found themselves in a bad spot.
Yeah, I mean, I think the narrative is upside down, and unfortunately it doesn't seem to be changing anytime soon. We're a society that likes to blame people and attribute failure to individual choices, and in reality, people we're serving may have made some bad choices, but very often these were choices because the marketplace was bad. They may have been sold a bad financial product that got them into debt. They may have taken out a student loan where they didn't realize the interest rate was going to be 8% instead of just 4%, and the payment terms were, they were never going to be able to meet them getting out of college. Again, I mean, I think there are definitely, I mean, people need to make good choices, and that's something we're about at CORE. We want to help them make the right choices to get ahead. But just what's happening in this consumer marketplace nowadays is that most people have a real hard time figuring out what is the right product for their needs, you know, what choices should they be making. And because of the aggressive marketing, I mean, you look at, if you look at late night TV, you'd be amazed if you spend any time or during the day sometimes at what products are peddled.
Your debts.
And
right.
yeah, and half of them, you know, our Attorney General, Lisa Madigan, we've done events with her, and she's, you know, she's going after half of these companies anytime during the year because, you know, unscrupulous advertising, really preying on people of limited means. But it's also, in many cases, and people we work with sometimes, they're desperate, and so they reach out to something that really isn't good for them. So at CORE, I mean, we don't charge for our services. We use, you know, we have a great partnership, for example, with the Illinois CPA Society. So we have hundreds and hundreds of accountants who volunteer with us who really have the best interests of our clients, our customers in mind. I can't say that for many of the businesses out there.
Well, it brings to mind something you and I touched on briefly before the show, about the choices that people are faced with and the level of sophistication that's necessary today to understand all of this advertising and marketing that's coming at you. And are people even prepared to be able to sort through what they're hearing? Most people, I mean, is that in your experience, do you find that they understand even how to sort this out?
No, and I think this is not an issue of low-income people. This is everyone, and increasingly in the studies that I've been reading, people are making poor choices, whether they are low income, moderate income, or upper income. The difference is if you're low income, you make a bad choice or two and you fall off a cliff. There's just nothing there for you. I mean, people have family, hopefully, to support them. You could be homeless, or you could just, you know, be locked into this kind of an endless spiral of debt. But I think the reality is we are ill-equipped currently as a society for people to make the right choices, given the sophistication of products in the marketplace, given the perverse incentives in terms that companies have to make money off people. The fact that we only finally now have a Consumer Financial Protection Bureau that the administration...
which hasn't really started yet.
Which hasn't started yet, and which, depending on the election, people may try to undo. And yet, most Americans realize that we need to do something to level the playing field so people have the kind of tools at their disposal, the ability to make choices, and some recourse. And I think that's the other thing, is that the policy environment is been so bad, and finally elected officials in the last few years have come around to the fact that maybe we needed to pay a little more attention to not only the banks and the financial institutions, but in general the kind of marketing that's done out there, and the fact that the products, the terms and conditions for anyone who's gotten a mortgage in recent years, you realize, my goodness, when we grew up, when we were kids, it was just a 30-year plain vanilla mortgage. It was a fixed rate of interest, and what was being peddled out there for the, you know, basically through the 90s and into the early part of this century, it's this century, amazing to think, but in this century, were products that were so esoteric, so many levels of detail in terms of the contracts that most people, unless they had an attorney sitting next to them, didn't know what they were signing.
Well, you mentioned top to bottom, and I think here's an example. These products are so sophisticated that in the recent meltdown on Wall Street, the so-called ultra-sophisticated investors were buying investment vehicles that they themselves didn't understand. Richard Fuld, the former chairman of the former Lehman Brothers, in fact, was famous for having acknowledged that he didn't really understand the market that they were playing in, and that's one of the reasons that the company went under. So if they don't understand it, what is the average consumer supposed to do? But let me ask you a related question. As we talk about this, the prevailing market belief, when we talk about the narrative and what's happening out in the market and what our economic culture is one where the University of Chicago School of Economics, that thought pattern seems to be holding sway, and that is that markets are self-correcting, and that anything that happens in the marketplace is good, because if it's really bad for consumers, then prevailing market forces will turn that around and bring it back. Those people who are swindling customers will go out of business, and those who are giving their customers a fair shake will take their place, and the market will self-correct. Do we see that really?
I see very little evidence of that, and I think the last 5 to 10 years, you know, would lead most people to believe that what you need a baseline of protection. There needs to be a set of core financial regulations that both cover products, that cover outright fraud. I mean, clearly there's people need legal recourse, but I think what still is missing is kind of the marketing, the ability to rein in some of the way products are talked about. I'm a firm believer at the end of the day in the marketplace. I think we do need a good, robust marketplace. But I think we need to provide both incentives for good businesses to offer good products, and we need to offer disincentives, or in effect regulation, for the bad products. And we need to clearly penalize people. I mean, one of the things that should have happened in the mortgage crisis early on is and unfortunately I think some state attorney general were trying to do it, but the federal regulators weren't doing it, is to pick some of the most egregious violators and make a public case out of them. Bring them out before the public, throw the book at them, and throw some people in jail. Not just treat them like white-collar criminals that the case takes years to come to court, and by the time it does, it's a suspended sentence, or it's just a 5 months, 6 months behind bars. But make an example of people, because that feeds again into, I think you put good behavior out there, bad behavior, and people see what happens, and they might adjust accordingly.
Well, in fact, from what I've read, there's actually quite a bit of evidence that at its core, the mortgage crisis was a case of widespread fraud. That in fact the people writing the mortgages, the mortgage brokers, the mortgage lenders, were in many cases writing loans that they knew were fraudulent because they felt, well, someone else will buy them, and if it ever goes bad, that's not my risk. I've sold that off to someone down the road.
Right.
So if it really is fraud, then is that where the marketplace has failed? And is that a case? And I'll say Alan Greenspan once famously said, as an aside, that he thought that fraud itself was not a problem because the market would correct for it. But here's a case where the underlying problem in the entire mortgage crisis was one of widespread fraud.
My guess is we have a lot of revisiting previous statements and utterances by former Fed Chairman Greenspan. Yeah. My guess is he might rue that comment, as he did with a number of other things. I mean, I just think the reality is that the marketplace is so complex nowadays, and also the ability of companies, whether they're mom and pop, and usually these aren't mom and pops. These are larger companies. They could be privately held, publicly held, but they can set up shop, and then if at their core of their business ethos is one of selling lousy products, fringe financial products, and even if it's not illegal, they know that they can move elsewhere. They can go to another state, another city. And indeed, one of the things we've seen, I think, in this crisis is we had a lot of people who got suckered in at every level, from consumers to people engaged in this, perpetuating these products. But at the end of the day, I think very few people actually have gone to jail.
No, very
and
few.
And that's one thing that I think, again, getting into a narrative of what this country is about, is that people should be punished. And again, if we had made more examples of people
who have broken the law, who've engaged in outright fraud, should be made to pay for that.
No question. Well, and I had a personal situation not too long ago. We had to refinance, as many people have done recently, so we had to get a new appraisal on our house, and the appraiser came by from our bank, and I got him talking, and it was one of those interesting stories, and I won't name the companies, where he just said he refused for about 5 years to do appraisals when they were for refinancings for several companies big in the marketplace, because he knew that at core it was rotten. Well, I told him, don't you have an association? Why didn't you step up?
Can't you turn
and he said, I could make the personal decision not to work with the companies, but at core, the whole appraisal industry was rotten too. Everyone was part of it. And that's where we get back into this narrative of the American economy and the bootstrap. Everyone's got to do well. Everyone's going to own a home. I mean, I think we all bought into it at every level. And going back to a little bit to my organization, Center for Economic Progress, I mean, most of the people we work with, they don't own homes. They may not even, they don't even have the incomes to qualify.
Well, they would have a few years ago when no one was
They might have a
looking,
few
right?
years ago.
But they wouldn't really have qualified.
Yeah, and I think we stopped as an organization. We've certainly promoted home ownership in the past, and we did, but about 4 years ago, we stopped because we realized that home ownership was just not realistic, even for the people we were working with who were making 30, 40, 50,000, who could technically, with some support and some match savings accounts we were offering with some of our community partners, some credit unions and banks, but that still at the end of the day, they could afford the mortgage, but they couldn't afford the maintenance cost.
Well, and I think that's a very important point, that many people feel that getting into a house is just a matter about meeting the down payment and meeting the mortgage, but it's not.
No, not at all.
If you've rented much of your life, you don't realize that, when you call up the landlord and say, hey, fix the radiator or fix the refrigerator, when you own a home, that landlord is you. Right. And whatever it costs to make that repair, you have to do that. And maintaining a home is actually expensive. Even a modest home in the suburbs is expensive to maintain. Things break.
Well, and we live in a climate that's unforgiving when it comes to home maintenance too. Yeah, I mean, I think
yes.
we've experienced it in my own family, but I think just again from the perspective of our mission at the Center for Economic Progress, it was a tough choice to make, to say, you know, home ownership is just, you know, when our counselors would sit down or volunteers with someone who wanted to purchase a home, and we for years we had pushed it because there were some very good, safe, you know, mortgages out there. There were incentives offered by the state, some of the community partners we had. But at the end of the day, you know, so you can afford that, you know, $1,000 or $1,200 a month mortgage payment, but then you got to add the taxes on top of that. And then on top of it, you better put an insurance, and then you better put aside $300-400 a month for maintenance costs. And before you know it, you know, they're at 70-80% of their overall income.
And it's,
in terms of housing costs.
It's a terrible idea.
Yeah, and I think that, I mean, that gets again to some of the aspects of our economy being upside down. I mean, on average, the recommendation in terms of financial management is that no one should be spending more than about 30% of their income on housing. But in metropolitan Chicago, there are a lot of people who are spending 40, 45, even 50% on housing. That doesn't leave a lot of money for other everyday basics, and needless to say, the emergencies that in the end, you know, that people really need to save for.
Well, particularly when I was in the mortgage industry for a number of years, and the excuse me, the ratios were 33 and actually at one time it was 25 and 33. 25% of your gross income,
that's right,
was supposed to be what you spent on housing, and 33 would be your total debt load or ongoing monthly payment. And then it went up, so I think now 33 was the housing portion, and 45 or maybe 50 was the total debt. But if you look at that, even those ratios, that extra debt load is something else that on top of the mortgage that people, I think, have been grossly misled about. We think about college students getting out of college owing $120,000 in debt.
Right, just insane
just
dollars.
They're starting their lives in a hole that they may never dig out of.
Well, one of the most, the scariest statistics that came out a few months ago, I think part of the Fed Consumer Finance Survey, is that at some point earlier this year we crossed a threshold for the first time ever. Total student debt in this country exceeded revolving credit.
That's
about
scary.
$900 billion. And when you look at the marketplace right now in terms of jobs and what entry-level jobs are paying, we have a lot of people who've invested a lot of their resources in education, which again is a prevailing value, and we want people to do that, to pursue education. I mean, all the data show that, you know, there's accrual over a lifetime for every year of education post-high school. But if at the end of the day you're graduating with a four-year degree, but you're locked in a job making $28,000 a year, and you're carrying, you know, $50,000 of debt or more,
or 100,000,
or 100, yeah. But you're just you're never going to get ahead. And I think where we've seen again, you know, the slippery slope. A lot of folks that we've been serving in the last 2 years are younger people, you know, in their 20s or in their 30s, where there isn't that hopefulness that there was before.
Well, so let's talk about a specific example. Say if I were a 22 or 23-year-old and coming in to see you and had $100,000 in education debt and was making $25,000 or $30,000, what would you tell me? How would you work with me in that case?
Well, I'd rather reverse it and say we'd prefer to get that young person at about age 18, when they're leaving high school, and this is part of a program we call Financial Aid U that we're running through Chicago Public Schools and partnering with, you know, other schools throughout the region on, that really provides the kind of supports, the kind of counseling, the kind of advice. So everyone understands, okay, so you have to apply for financial aid, and you're going to get some need-based aid depending on income, but you also will likely get offered loans, and you might want to take advantage of loans, but you want to look at what that ratio is going to look like after 4 years of school. And again, if you graduate after 4 years, that's one thing, but if it takes you 5 years or 6 years, it could be even more costly. And I think this gets to, again, one of the disconnects in our society, is that we're sending people into the prime years of their life, and they don't have the kind of skills to really do some basic back-of-the-envelope calculations on what's the value of everything I'm putting into this, i.e. education, and what do I get out of it. And again, I'm a firm believer a 4-year degree is hugely worth it, but maybe you better think through, okay, what's that degree going to be in?
Well, and there are different ways.
How much debt are you going to accrue? And, you know, are you fully taking advantage of college work study, of maybe working during the school year?
Could you go to a cheaper school?
Or to go to a cheaper school. I mean, again, we partner with city colleges. Some of our strongest partners are city colleges of Chicago, in the suburbs, Waubonsee Community College out in Aurora, We've worked certainly with College of DuPage as well, but you know, for the money, these are great values. And you may not get the 4-year degree, but you'll get a 2-year degree, and then you could pursue that bachelor's. But your debt will be way lower than if you went to a 4-year school from the beginning.
I briefly taught accounting, in fact, at Triton College,
Uh-huh.
and had that same experience where I would see the students come through. And interestingly, many of them went to the community colleges because their parents couldn't afford to send them anywhere else,
Right.
and they weren't working enough. And I would tell them, look, this is a good deal for you.
Right.
Don't
right.
worry about this. You're going to get 2 years under your belt here, and then if you do fine here, you'll have no trouble getting accepted to a 4-year college, and you will have saved 2 years of that major tuition. But no one had actually explained that to them before.
Right, right. Well, and I think, I mean, when we do see, and I'm not in the business myself of counseling anymore, but when we see young adults who have successfully navigated their way from a low-income family into a job and a 4-year degree, some of the best stories, I will tell you honestly, are folks who did go that route of a 2-year school to start with. They might have been able to get into a 4-year school, but the financial realities just were not possible for them. So they graduate with an associate's degree, but maybe with $2,000 worth of debt, and then they can go to, you know, they can transfer, go to a DePaul, go to Loyola, go to University of Illinois, whatever that school might be. Again, this is where we need to connect kind of people's financial vision with their career vision and step back, because I think just like with the mortgage crisis, people's dreams get ahead of themselves, and it's not like people shouldn't be dreaming about the future. They always should, but they might need to really sit down with a counselor, with someone who can advise them, who's neutral, who's not peddling a product or a service, who can say, you know what, let's really calculate this out. Let's see how this adds up.
So
and that's the approach kind of at core that we want to be using as an organization.
So how wide is the reach of the center? I mean, how do you let people know you're there? How do you bring them in? When do you get them?
Well, we have no problem bringing them in. We actually have demand that far outstrips our capability to serve people. So our bread and butter service is we provide free tax preparation assistance, and that's strictly a transaction. It's a one-time-a-year thing, but we use that as an entry point to moving people into good financial products and services, help them save for the future. Very often, a low-income family we work with is going to get a sizable tax refund instead of
the earned income tax credit.
The earned income tax credit, the child tax credit. I mean, the average, again, I said earlier, the average income for a household we serve $15,000, but the average refund is $2,000. So they're getting a boost in that refund, and they could, of course, spend it right away, but we encourage them to save at least part of it for a rainy day. But we partner with banks and credit unions, so people who don't have an account can open up an account. Now you can actually split your refund into multiple accounts, so you can, in addition to maybe saving money through your employer, you could take $1,000 of that refund and put it into a savings account. And it might be just an everyday savings account, or it might be, you know, an account for your child for pursuing education.
You talked about partnering with the banks, but what kind of reception do you get? I mean, part of what you're doing with the center is saying, look, a lot of these bank products are really not in your best interest, and these guys are going to try to sell you this stuff, and don't listen to them because you need to think this through in a different way. So how does that affect your relationship with the banks you're working with?
We walk a fine line, but I will tell you, we partner with many of both community banks, major national banks, and a huge number of credit unions. We push plain vanilla products, very basic checking and savings accounts with low or no fees, no barriers to entry, low penalties. No interest. I mean, no one's getting any interest.
Right,
even on a one-year CD, you're getting, you know, under 1%.
Right.
I mean, we're really careful about that, and the goal is to make sure that people have a good experience. At the end of the day, we're a nonprofit organization. We don't have the products ourselves. People do need to successfully figure out what are the right choices for them in the marketplace. But if they have some good experiences, if they make some smart choices, it can put them in the direction where they're going to be in a better position down the road. But at core, you're right, there is a bit of a tension there, and there definitely, you know, there have been some, you know, very bad players in the marketplace, including some of the larger financial institutions.
How do you guys react to the payday loan industry? Is that something that you think can be managed, or is that something you steer people away from altogether?
Oh, we steer them completely away from it. I mean, we steer them away from refund anticipation loans, which the tax preparers offer, which are the same as payday loans. Payday loans are just, they're a bad product, but they have exploded in the marketplace. I mean, there are more
hugely profitable
payday loan franchises, individual stores in Illinois, than there are actually McDonald's, which gives you a sense of just how they've taken over the landscape.
That's astonishing. I would never have guessed that.
But it's, you know what it's all a function of? It's that people's incomes are not keeping up with their expenses. Many people have actually seen a reduction of incomes in the last 10 or 20 years, and so they're borrowing, and this is an easy way to borrow because the bank won't give them money, so they go out for a payday loan, but then they get caught in the cycle of debt. I mean, I believe in a free market. I think at the end of the day, we can't just ban them, but we can certainly create onerous conditions, and there have been some regulation at the state level, but this is an industry that has fought tooth and nail every step of the way to ensure that they're still allowed to operate. And now you have a preponderance, you have many moving to an online, payday loan product, so people can just do it through their computer where it avoids all regulation.
And their argument, of course, is that in the free market, they're providing lending services to consumers who have no other choices. And so therefore, they're filling a true market need, and the laws of economics being what they are, they should be allowed to operate. But there's another side to that story, right?
Well, I think there's a variety of it. First of all, there's fundamentally a failure of the market because banks and credit unions should be offering people short-term loans when they need it. But if they don't have equity, in many cases, they're just not going to do it. I do think that, payday, we do not argue in our organization for products to be banned. We argue for them to be regulated and also for there to be really rigorous disclosure principles. And it's the same thing that you and I look at when we now in our credit card statement, where it tells you at the back of it, not the one that tells you about all the privacy rules, which is like 50 pages, but at the back end where it tells you the actual interest rate, and now there's going to be even more information that's going to tell you, what this actually means, and if you take X amount of days to pay. I mean, those are all the kind of upfront disclosures that should be required, and that I think would give people at least more tools to make some choices. But if you're also making, $8, $9, $10 an hour, and you really need to be making $12 an hour given your cost of living, you're going to end up falling into these traps over and over again. And so that's why we do need jobs that pay better at core. Now, that's not central to our mission, but we talk about it a lot, that the fact that, the types of jobs being created in this economy, even now with unemployment is bad, we don't see enough jobs that are providing the kind of wages and benefits that people really need to make a living.
Well, it's going to be an ongoing problem, and as having just come out of an election where the prevailing economic philosophy of the party that has been elected seems to be contradictory to that. The idea of guaranteeing wages, the idea of trying to spur high-paying jobs, it's been given a lot of lip service, but it's not clear that those policies will actually send us in that direction.
Well, I'd agree. I mean, we have to take a step back, and I think that, yes, it's an election. I'm not sure there's a mandate. I think there's a lot of anger, and a lot of it is well placed. I mean, I think politics at core in many places around the country has become corrupt. But I think we need to turn the story around, and the reality is that government can play a role in people's lives. It can't force them to do anything, but it provides a floor, and that's why, in our work, working to promote access to the Earned Income Tax Credit, making sure that people get all the refunds they're owed is absolutely essential. Just like, in this down economy, more and more people are accessing food stamps. I mean, we shouldn't be in a position in one of the wealthiest countries in the world for people to have to cover their basic nutrition through government support, but they would be out on the streets if it weren't for a program like that.
Well, David, on that note, we're already out of time. So I'll have to ask you to come back again in the future. It's a fascinating
I'd be glad
topic.
to join you. Thank you very much.
So thank you so much for being here, and thank you for joining us. We've been visiting with David Marzahl from the Center for Economic Progress. I'm Kevin McDermott. You've been watching Public Perspective, and you can see us every Saturday night at 8.